On AMD's earnings call, a Wall Street analyst estimated that the company could generate roughly $30 billion of AI chip revenue in 2027. Then Lisa Su responded,
The analyst was being too conservative. AMD's data center AI revenue could be even higher than the $30 billion.
AMD had just reported record revenue, its data center business had more than doubled, and its guidance came in above the Wall Street expectations. Yet, the shares still fell after hours. So, what did investors see that the headline numbers were missing? Because the $30 billion estimate was specifically about AMD's Instinct AI chips, the product challenging NVIDIA in the AI accelerator market. And buried elsewhere in the call was one important thing. AMD's fastest growing AI business currently carries a gross margin slightly below the company average. I read the earnings release and the full conference call. Let's go through it. Let's run the Q2 earnings recap fastly because it's not where the story is. Record revenue 11.54 billion, up 50%. Adjusted EPS 1.66. Gross margin 56%. Data center 6.7 billion, up 107%. Now 58% of the whole company, and the Q3 guide came in near 13 billion, above the street estimate of $12.5 billion. But look at the size of the beat. Revenue beat by about 2%, EPS by about 3%, gross margin in line for a stock that had more than doubled this year and closed up 7% on the day before the print. A 2 to 3% beat is not a catalyst, it's a relief valve. The new information was not the quarter, it was the guide and the 2027 reset behind it. The bull case rests on three things this call made concrete on. Pillar 1, EPYC has become a second AI growth engine. Server CPU revenue grew more than 70%, fifth straight quarter of record. And management explicitly mentioned it was driven by units than the price. That's the real deployment expansion, not just charging more. And server CPU growth is accretive to corporate gross margin. It pulls the average up. Management now expects server revenue up more than 80% in the second half and more than 70% across the 2027. Pillar 2, Helios, is no longer a promise, it's a schedule. Lisa Su, Helios is a quote, now in production with initial shipment on track to begin later this quarter and ramp through the fourth quarter and into 2027. Anchor customers are OpenAI, Meta, Anthropic, Microsoft, Oracle, all the hyperscaler. And she said demand is running ahead of AMD's own forecast. But she was precise. This about volume, not the yield. Hold that, it returns in the bear case. Pillar 3rd. The real reset. AMD raised its own earnings ceiling. Lisa said revenue growth will run substantially above the prior target of greater than 35%, and the company will significantly exceed its $20 EPS target in the strategic time frame. And the CFO gave the mechanism. Operating expenses will grow slower than the revenue. That's the operating leverage lever, the thing that turns revenue into EPS. Then the anchor. When a Cantor analyst modeled roughly 30 billion in 2027 instinct revenue, Lisa's answer was essentially it is too low, and she told the room to read over 100% data center AI growth as well over 100%. The segment is guided to more than double next year. So, if the demand is that strong, where is the risk? It's not demand, it's conversion. The four part 1. Margin mix. The fastest growing part of AMD's data center AI currently carries a gross margin slightly below the company's average, while server CPU sits above it. So, the uncomfortable arithmetic revenue can grow well over 100% and gross margin can still go sideways because the AI ramp is slightly dilutive to the mix. Management's own word for it was that server and AI create a good offset. To be fair, the CFO also pointed to other levers to push margin up, embedded client operational work, but here is the scope that matters. That server versus AI offset holds the line. Expansion has to come from somewhere else, and offset protects the margin, it does not grow it. That's the crux of the stock. 2. The ramp is back-ended loaded. Helios is Q4 2026 into 2027 story. Revenue that lives in the future depends on data center readiness and deployment timing you don't control. Real demand does not guarantee the cadence. 3. Early ramp economics. Lisa said yields will improve over the first few quarters, which suggests early ramp economics are not yet at Helios' mature cost structure. A rack scale system stitching together the CPU, GPU, networking, memory, and software is the most complex thing AMD has shipped yet. Complexity shows up a cost before it shows up as leverage. 4. Expectations. If the market already prices more than 30 billion of 2027 AI revenue plus 14 plus percentage of corporate growth plus margin expansion, then even hitting the management raised target might only meet the price, not beat it. In an expensive AI name, good news is the baseline and not the upside. Now let's do the valuation. Now let's price it. And I will flip the usual exercise. Instead of guessing a fair value, ask the only question that matters. What must AMD deliver to justify today's price? AMD is worth approximately 800 billion today after the drop and still moving, so treat it as a range. For an investor, buying a stock today to earn a 10% annual required return through the end of the 2030, about 4.5 years is remaining. The equity has to grow roughly 1.23 trillion, but a 20 times adjusted earning multiple on that, and AMD needs 61 billion adjusted net income by 2030. Here is the part that does the work, the adjusted net margin over 4 fiscal year of growth. At a 30% adjusted margin, that's about 205 billion in revenue. Using an illustrative FY 2026 revenue estimate, nearly 50 billion, getting to the 205 billion needs a roughly 42% CAGR growth. That's roughly consistent with the management's line that AMD expects to outgrow a market expanding above 40%, though management has not formally guided a 42% company growth rate through 2030. And AMD's current adjusted net margin is about 24%, so the 30% margin means real margin expansion on top of that growth. One honest caveat, because it's the biggest swing factor, this is highly sensitive to the exit multiple at 25 times adjusted earning instead of 20. The required 2030 revenue at a 30% margin dropped above the 205 billion to about 164. I use 20 times as a conservative mature growth multiple and not as a prediction, but the shape holds. On those numbers, today's price does not assume AMD does well. It assumes AMD delivers something closer to its raised growth and expand margin by 6 points and keep some healthy exit multiple in 2030. All three together, that's why well over 100% in one segment did not move the stock up. So here is my actual view. This call improved the business. The revenue opportunity is bigger than it looked 6 months ago. The commitments are more tangible, and in 2027 it's more credible. But the stock is no longer waiting for proof of demand. It's waiting for proof that demand becomes high margin, cash generative earnings. At this price, revenue growth is table stakes. AMD has to deliver the growth, the margin, and the cash conversion at the same time. On night after hours, reaction is not the verdict on all that, but the message was clear enough. Headline growth alone is not going to re-rate the stock again. That's the tension I would want to resolve before I underwrote the stock at this valuation. Three things that I will track, all publicly reported, so you can check me. 1. Revenue conversion. Does Helios set up Q3, Q4 to Q1 2027? Does the customer list broaden past the anchors? Does AMD move from well over 100% to an actual data center AI dollar figure? If that 30 billion estimate keeps moving higher without deployment delays, the revenue leg of the bull case strengthens materially. But that's the revenue leg only, not the whole thesis. 2. Earnings quality. What's the consolidated gross margin? Does it hold 56% or better while AI scale up? What's the data center operating margin? 31% this quarter. Does it stay near 30 or recover toward it after the initial Helios ramp up? A mix driven dip during the ramp is not automatically a failure. A sustainable slide is. And watch EPS growth versus revenue growth. If EPS keep outrunning the revenue, the operating leverage is real. 3. Cash conversion. Free cash flow was 1.6 billion this quarter, down from the 2.6 billion with the inventory built for the ramp. Understandable now. But by 27, if data center revenue more than double and company free cash flow does not scale materially, the quality of the growth becomes the central concern and not the growth. If this earning call and filing level breakdowns like this are useful to you, this is the channel for the next big AI print. Tell me in the comments which assumption in that valuation table you would challenge. I will defend it or update it. See you at the next one. Thank you.